Good afternoon, ladies and gentlemen. My name's Steve Fletcher, and on behalf of the distribution team at GSFM, thanks very much for joining what is the final Munro Partners webinar for 2023. It's obviously a very busy time of year. However, we wanted to make sure that you have an update on the Munro funds, which will assist you with your conversations with your clients as we head into 2024. Now, before we get going, I just thought I'd take this opportunity just to provide you with a quick business update. The Munro and GSFM teams have been very busy since our national roadshow back in August with the launch of a new fund, the Munro Global Growth Small and Mid-Cap Fund, or Munro SMID as we refer to it. Chow Ma, who also presented at the National August Roadshow alongside Nick, is the lead portfolio manager on this strategy, and Chow will join the webinar a little bit later on. So the idea behind the launch of this new fund really is to complement the existing Munro Global Growth Equities funds lineup. The flagship Munro Global Growth Fund, or the long-short fund, provides access to an all-cap concentrated portfolio, but with added capital preservation tools, really aimed to deliver that smoother, less volatile investment journey for investors. The Munro Concentrated Fund, a 20 to 40 stock portfolio for those investors who want a long-only, fully invested, unhedged strategy. We also have the Climate Fund, a thematic offering providing access to companies that are best positioned to champion and win from this structural change. And then, as I just pointed out, the new SMID fund is targeting companies of less than $30 billion market cap, really investing in those earlier stage companies on their growth journey. And really, because Munro already know these companies from their competitor and channel check research, the in-house expertise and idea generation is already there. So for this reason, we feel it makes complete sense that Munro offer investors access to their own investment capability in this smaller cap segment of the marketplace. So you'll hear a lot more about the SMID fund early in 2024 as the fund makes its way onto platforms, etc. But in terms of global growth equities, Munro now have a full suite of offerings that really leverage the proven stock picking capability of the firm. So turning to the webinar today, we'll run for approximately 30 minutes, and the agenda will loosely follow, first of all, sharing with you performance and positioning of the Munro funds, in particular the Munro's flagship Global Growth Fund. Nick will share his market outlook, and then we'll also discuss with you what the team are working on today, the idea generation that will assist in delivering the performance objectives for all of the funds over the next 3 to 5 years. And then finally, as I pointed out, Chow will join the webinar a little bit later on just to talk about and discuss some of the opportunities for investors that are presenting themselves right now within that smaller part of the market. So please don't forget to ask your questions along the way. This will help set up for an interesting Q&A session at the end. We've got a lot to get through in a very short amount of time. So with that, what I'd like to do now is introduce you to Nick Griffin. Many of you know Nick. Nick is a co-founding partner and also the Chief Investment Officer. And with that, Nick, I'm going to hand over to you. Thank you.
Yeah, thanks very much, Steve. And thanks very much, everyone, for dialing in. I know it's Christmas time. I know people have got Christmas lunches to get to. So as Steve said, we're going to go through this very quickly. I'm basically going to give you a short recap on where we are, a short outlook for markets, but mostly we're going to spend a bit of time talking about how we've got the funds positioned for next year and the years ahead. So look, very quickly, just to remind anybody who might be new on the call, Munro Partners was set up basically 7 years ago to be your global growth investor. So our goal is to do global equities and to do growth. Our products are designed, to give you hopefully double-digit returns through the cycle, and thankfully they have done that since inception, and they've done that even after the big adjustment that we had back in 2022. We run roughly $4 billion in assets under management. We have 28 staff. We run a partnership. We own and control 75% of our business, and we're all based here in Melbourne, Australia. And please don't be afraid to come and visit us if you're ever coming through town. As I said, we'll try and keep this quick. We run 4 main products. Steve just basically told you about them very quickly, but this what we've been trying to do over the last 7 years is really build a suite of global equity growth products that you will find useful, that all access the Munro Partners investment process. And the first one we launched is the one that most people are probably invest in, which is the Munro Global Growth Fund. This is a growth equities with an absolute return focus. The important thing about this product is we don't think it's a relative return product. The product is designed to try and give you that double-digit returns through the cycle. And as I said, it's done that. And that product's running at around a beta of 0.7. So it's growth equities, smoothing the ride. Second product that we actually launched nearly 4 years ago now is our long only product. So that's the same thing, but just without the downside protection tools. And that runs at a beta of roughly 1.2. As Steve flagged, we now have the full suite of products since Chow joined in February, and we have now launched the Munro Global Growth Small and Mid Cap Fund. So this is our SMID product. And so this is everything under 30 billion in market cap. It was launched last month. Again, it's a long only product. And again, it's higher risk again. And so there's basically a whole suite of different risk products you could look at here, all looking at global equities growth. And then our last product that I'll talk about potentially at the end of this webinar is our thematic product around climate change. And this is where we're investing in the enablers of decarbonisation. And so most of today, I'm going to be talking about the first two products, you know, what our outlook for market is and how we're positioned in these products. But at the end, we'll also cover the last two. And then lastly, just to recap on these products, this is what they've performed for the year to date across the group. It's an important time of year. It's a time of year where you're writing your outlook for 2024. I'm sure you guys are doing the same, and I'm doing the same thing. And it's also a good time to reflect at what happened. And so from our point of view, 2023 has definitely been a recovery year in equity markets. 2022 was clearly very difficult. We'll talk about why. Most people are across the reasons why. 2023 was a recovery year. A lot of people were still worried about a lot of things, but ultimately equity markets recovered. We captured that best, obviously, in our long only product, where the fund was fully invested throughout the year, where you picked up the long equity returns and some of the FX gains that were there. The absolute return product did have some drag here. We did start the year too conservatively. I'll talk about this in a second. We were worried about an earnings collapse that didn't actually appear. And if anything, you know, there was some drag here from short equities and things like hedging. We knew we were near the end of the cycle, but we felt that we wanted to make sure that we protected the absolute returns near the end of that, also the end of the down market. We wanted to make sure that we protected against any absolute further drawdowns post 2022. A lot of this drag was actually occurred in the first and second quarter. Since the June quarter, both these funds have actually been very much aligned and very much performing in line with each other. Below, we have the Climate Leaders Fund. It was a more difficult year for climate. We'll definitely go into some of the reasons why, but clearly interest rates affects the climate opportunity more than, say, it affects the technology opportunity. Why? Because it's a physical opportunity, not a digital one. And lastly, you can just see that SMID Cap Fund we've been talking about, and we launched in November, and it's obviously off to a very strong start. Okay. So charging along to probably the stuff you do want to know about, you know, what's the outlook for 2024? What do we think 2024 and beyond is going to look like? And it's important to talk about 2024 in the context of what happened in 22 and 23. From our point of view, it is worth reminding people that, you know, this is your long-term interest rates over a long period of time, i.e. your US 10-year bond rate, and this is debt markets globally. 2022 was a huge shock to the system. Rates effectively went from 0 to 5%. That's something that we quite frankly haven't seen in a very, very long period of time. And this was a huge shock. It happened because we came out of COVID so quickly. COVID basically caused, as we came out, that created supply chain issues, that created inflation, and the Fed had to react to that. And as we go forward from here, what was really interesting is we had that huge shock to rates in 2022. And what everyone thought that would do is that would create a big collapse in earnings. Interest rate would move first, and then earnings would collapse second. And this is just a good chart to try and show what a lot of people, including us, including us, thought might happen at the start of 2023. And this is the P multiple of the S&P 500, and this is the S&P 500. And what you can see here is the S&P P multiple ranges between 16 and 22 times. In 2022, it derates dramatically. Why does it derate dramatically? Because interest rates go from 0 to 5%. It also derates dramatically because everyone assumes that earnings over here are going to collapse. Here I'm showing you the S&P 500, I'm showing you forward EPS. But what ended up happening is earnings did not collapse. Earnings actually grew throughout 2023. And the equity market just does what the equity market always does. It follows its earnings. And so the equity market went back to following the earnings. The earnings did not collapse. And the big question everyone's struggling with is why didn't they collapse? And the reason why they didn't is because what we know and what we should have known and what we definitely have preached for many years, and even in this latest cycle has proved again, is that the stock market's not the economy. The S&P 500 is not the economy. And particularly the biggest companies in the S&P 500 all grew earnings in 2023. And the reason why is because these big structural changes came along that ultimately accelerated earnings. And so whether that's in high performance computing or AI, you see NVIDIA, you know, NVIDIA's earnings went up nearly 400% this year. Or whether that's Google and big cap tech, they were able to cut costs. Their earnings actually turned in February. whether it's Eli Lilly from GLP-1s, their earnings actually grew all through 2023. And even Visa, your standard digital payments company, continued to grow throughout 2023. And so the big moral of the story for 2023 is that earnings actually growth drive stock prices. And as soon as interest rates stop going up, stocks will just go back to following their earnings. That's what happened in 2023. And to be fair, we see no reason why that's not going to continue in 2024. This was a framework I showed. I went back and looked at my outlook. This is a framework I showed at the end of last year, saying, how do we know when to deploy the cash that we'd raised in the absolute return fund, or how do we know when to get more aggressive markets? And we said there was three things you're after: long-term interest rates to peak, time, it takes about a year for the macro to be priced, and earnings estimates to bottom. And at the start of this year, we had two ticks here. We had a tick here and a tick here and a cross at earnings estimates. And what happened is earnings estimates bottomed much quicker than we thought. They bottomed in February. And that's when we started putting the cash back to work. That cash is now all gone back to work. It's been back to work since May. I showed this slide on the August roadshow with 3 ticks in it, and I fully intend to retire this slide after this period of time. As you sit here today, we're probably more confident that interest rates have peaked. We're more confident that earnings have bottomed and going up, and you should have easily priced this macro downturn. I get that there might still be bumps in front of you, and I get that there might still be some left field events that come along, but ultimately this is the framework that suggests that the next bull market has probably started, and it's probably going to run for a long period of time. And yes, the market could get ahead of itself, but there's no reason to say that this framework hasn't changed, and there's no reason to believe that this earnings growth won't continue into the future. And so what we've been thinking about all through 2023 is, A, how do we get the cash back to work, which I said we did through February, March, April. And then secondly, how do we position this fund, not just for next year, but how do we position for the next 3 to 5 years? Because that's how bull markets go. Bull markets go for, on average, roughly 64 months. Bear markets go for on average of 12 months. If the bear market finished at the start of this year, then you're basically halfway, less than a fifth of the way through the next bull market. And what we should be doing is thinking about how do we position this fund for that next period of time. And that's really what we spent most of our time doing. And that's what I'm going to spend most of the next 20 minutes talking about. So how's the fund positioned? What have we done? What are we working on every day here to try and capture these great opportunities, capture these great structural opportunities into the future? This is just a graphical representation of the key all-cap global growth mandates at Munro. So that's the Munro Global Growth Fund and the Munro Concentrated Global Growth Fund. So both our absolute return and our long-only strategy are effectively following this template. We publish this in our monthlies and our quarterlies every month and quarter. And it really just, it's essentially what you're paying us to do, which is to identify the areas of structural growth and identify the winners. And as you can see at the end of November, and as we go into 2024, the biggest area in the fund is high performance compute. So this is high-end semiconductors that are effectively driving the AI revolution. It's over 20% of the fund now. It's 8 holdings, of which NVIDIA is the biggest. Below that is digital enterprise. This is cloud computing and software. It's roughly 20% of the fund, 4 holdings. These are 2 big bets, and they're 2 mainly focused around AI, and I'll definitely talk about that in a second. Below that, you look at digital payments, where we've taken this period of time to basically move down the market cap curve somewhat, and picked up an investment in Wise, which obviously Kieran presented at the SON conference last month. In healthcare, we still like GLP-1s, but we're definitely adding new ideas there. And then down here in internet disruption and consumer, I'll talk about some other things that we've taken the opportunity this downturn to basically invest in some companies that we've really admired for a long time, where finally the valuation's giving us an opportunity where we feel the risk reward's good enough. But let's just talk about the top 2. Let's talk about AI. So why are we so excited about AI? Okay, so I've said this a lot this year, and I'll just say it one more time. We think this is the iPhone moment for artificial intelligence. ChatGPT coming out in December 2022 obviously caught us and the market by surprise. We moved very quickly, as I said, in February to invest in it. Why do we think this is the iPhone moment? In my career, many people on this call will remember when they first saw an iPhone. They first saw an iPhone and they basically went, I want one of those. And now every single person on this call has an iPhone, and they use it sort of like an augmented part of them for the last decade. The iPhone came out in 2007. Apple was a $70 billion company. Today, it's a $3 trillion company. Why was the iPhone so successful? Because it made the internet mobile, okay? So the internet was on your phone before you got it, before the iPhone came along, but the iPhone made it usable. It created this app ecosystem that you use every day, whether it's maps, whether it's fitness, whether it's social, okay? On the right, we are firmly of the belief that generative AI is pretty much the same thing. AI had been around prior to this year, but it was really the domain of the biggest companies. And now generative AI means that AI can be used by just you, the consumer. It can be used by anyone. And so you're going to see infinite applications for AI be developed over the next 3 to 5 years. And some of them are being developed already. And so what I'm going to do now, because it's December and because it's that time of year where we can show a few videos, what the team have done have shown a couple of products that we've seen just start literally within the first 12 months. So ChatGPT came out in December, and these products are already available for you to use. And so the first one I'll just show you, and maybe you'll get an idea as to why this is going to touch everything. This is Adobe Firefly. This is us in the marketing department trying to find pictures of Munro Mountains. Now, as we look at our Munro Mountains, we can use words to get them to change. We want Munro Mountains in summer. Or we quite like that lake on the right. We want Munro Mountains with a lake in the middle. And then we want it to look really Scottish. We want Munro Mountains with flowers in the foreground. And then you're actually finally got the picture you're looking for, and you can click on it. And so rather than trawl through thousands and thousands of pictures on Adobe like you normally had to do, you can do it with just words. That's AI being used for real world applications. Second opportunity I'll show you is just another one that obviously Chow pointed out to me about halfway through the year, was Pinterest. Okay, so Pinterest is just a site that you used to share, look at pictures. But now say I want to find a picture. I want to find a picture of George Clooney looking smart in Italy because I want to look smart in Italy. I can click on George, I can click on his sunglasses, and I can find his sunglasses. This is an e-commerce application that effectively is using the same generative AI. And to be careful, for the ladies, you can click on Amal's handbag and you can find the handbag that she's looking for, which I'm told from the marketing department is there's the Loave handbag, and this is the one you should be looking for this Christmas. And so from our point of view, I'm just trying to show you a couple of examples here, and this is what we've been doing as a team all year, is the more we look at this, the more we think there's just quite literally infinite applications of AI or generative AI. And so every company in the world at the top here is going to come up with some sort of generative AI product. And as you can see from those two, it's going to be quite useful. It's going to save you time. It's going to lead to better conversion in e-commerce. It's going to save you time in creative. It saves you time if you wanted to just summarize this meeting. And so all of these applications are going to be developed across healthcare, across finance, across e-commerce, across creative, across productivity tools, whether it's Microsoft Copilot. And all of them are going to plug into these generative AI models. And these generative AI models are going to give you those predictive outcomes. I just showed you two. To get them to work, you're going to need all of your data to run on the cloud. And then the cloud providers are doing what they've already told us they're going to do. They're going to increase CapEx massively to support these products. And all of that CapEx is going to end up with NVIDIA and NVIDIA, the supply chain. So just taking a big step back through those examples, the simple way we've been thinking about it is at the top, this is the application layer. This is effectively panning for gold. I just showed you two companies who've got some great products. There'll be like hundreds. Some of them will be very successful. Some of them won't. But down the bottom here, you can just buy the shovels in the boom. And the shovels in the boom, you can really count on a couple of hands. It really is the cloud providers and the semiconductor universe that supplies them. And so this is what we've done with the fund. And so when we look at the cloud providers, we think everyone should be invested in the cloud providers. They're the ultimate shovels in this boom. This is where all of these generative AI applications are going to work and where they're going to be created. And every time you use one, every time you try and create that Adobe picture, or every time you try and search for George's sunglasses, you're going to be increasing revenue to these cloud providers because that's where all of these things are going to operate. On top of that, at the application layer, we think the biggest software companies are the biggest winners here. Put simply, Microsoft will create Microsoft Copilot. I just showed you the Adobe product, ServiceNow or Intuit. And now Intuit is effectively QuickBooks. It's accounting software in the US, but just really simply, all these companies are going to do is take all the data you've already given them, i.e. your invoices or your accounts, and create generative outcomes back to you and sell it back to you. And they're going to be able to charge you a premium for that. Microsoft is selling their Copilot product at roughly $30 a user. That's effectively double the price that you pay for Microsoft today. And this is a huge revenue opportunity for these companies and a huge revenue opportunity for these companies, and obviously a huge growth opportunity. And that's why we think it's where you want to be going into next year and beyond. Just moving to the semiconductor opportunity, we think is actually even bigger. And so every time you're trying to generate these outcomes, you are effectively needing more and more compute power. You're needing more power and more compute power. This is just a great slide that shows you the semiconductor market over the last 50 years. Okay, so semiconductors have gone from nothing in 1977 to roughly $1 trillion in 2030. We've been through the mainframe era where basically the only person who could afford a computer was, NASA or a large corporate. And that created IBM, which at that time was the biggest company in the world. Semiconductors got small enough and fast enough, and that created the PC era. We could afford a computer in our house. That created Intel and Microsoft, of which Microsoft became the biggest company in the world. We then shift to the mobile era that I just talked about. The mobile era saw another 10x growth in semiconductor demand, and that created companies like Qualcomm who helped build the Apple phone, but ultimately Apple that became the biggest company in the world. And so we are now at the AI era. As I said, all of these products are going to get built. People are going to use them. And so you need to connect every single device on the planet to the internet. And all of that data has to go to the cloud and be processed really quickly to create generative outcomes. This should create another 10x demand growth in semiconductors. And we think potentially NVIDIA becomes the biggest company in the world out of this. But you don't just have to look at NVIDIA. You can, quite frankly, just look at the whole supply chain. Because what's really interesting that's happening in semiconductors right now is to get these generative AI products to work, you have to change the design of the semiconductor. You have to change the way semiconductors have been designed for the first 50 years I just told you. So on this call, you would have heard me come on, or many of my colleagues come on and just talk about shrink, shrink, shrink. Everything's about shrink. Well, that was the CPU era, that was ASML. But what happens now in generative AI is you combine CPUs and GPUs together. You put them together to basically create these individual decisions. Is that a cat? Is that a dog? Is those George's sunglasses? Are they not George's sunglasses? And so to give you an idea, this is what a generative AI chip looks like, or the H100, which is the NVIDIA product that's causing all the growth at the moment. This is your standard Intel chip. It's a CPU processor. It looks about that big. It costs roughly $200 or less. This is the H100. This is the product that is driving all these generative outcomes that people are trying to get their hands on. It's roughly 10 times the size and it costs $24,000. Okay, so as we go over time, all of these chips are going to be bought for the data center, but over time, we expect you'll be designing generative AI chips for PCs and you'll be designing generative AI chips for smartphones. And this is already starting to be talked about and already starting to be designed. And so what Charles says, which I think is a good call, if you go back to 2007, the best way to make money out of the iPhone era was to get the iPhone and smash it apart. And you smash it apart, you look at all the different bits, and the different bits were how you were going to make money out of mobile generation. In this case, if we take the H100 and smash it apart, it looks like this. And so what's happening with the H100 and what's happening with these chips is you're effectively stacking things like memory next to logic, and you are effectively stacking these things with things like hybrid bonding technology, and you're also having to use significantly more things like metrology, et cetera, to look at this. And then you're also having to use significant software to design these products. And so what I'm sure I'm going to get asked on the Q&A is, who are the big competitors to NVIDIA? What are they all trying to design? They're all trying to design chips that look like this, chips that are heterogeneously integrated, where the memory, the logic, and the CPU and the GPU are all integrated together in what we call advanced packaging. And so from our point of view, we are at this point where you effectively have to not only re-architect the data center to get these generative AI products work, but eventually you're going to be re-architecting semiconductors in PCs and also in mobile. And that's what we've tried to invest in high performance computing. And so what we've done here, this is roughly just over 20% of the fund today. What we've done here is obviously we like NVIDIA. It's a 6% position within that group. But what we've done is basically put together the other pieces of that large chip, which is Hynix in memory, TSMC and Foundry, ASML and Applied Materials in the tools that make the foundry that allow you to make these chips, Synopsys as to how you design the chips, and then finally the advanced packaging companies that are helping put them together. And what we're saying here is we're at the start of this great opportunity. We think generative AI will grow dramatically. It will definitely favor software companies and cloud companies, but it will also favor how we design chips. And those are effectively the two bets we tried to put on here. We do think we've got significant edge here. We've been talking about this stuff for decades with ASML. And we're just basically following through that process to its next iteration, which is going to be how we make these generative AI chips. And this is, as I said, some of the stuff we've been working on over the last year to position the fund into next year. Okay, so I just did way too much about AI. So let me just quickly talk about some of the other parts of the fund, and then I'll hand over to Chow to talk about SMID. So the two things I just talked about make up roughly 40% of the fund. Other parts of the fund are really focused around consumer, healthcare, digital payments, et cetera. Let me just talk about consumer really quickly. These are some of our consumer investments. Obviously, the consumer's not doing great at the moment, but that's ultimately giving us an opportunity to invest in some consumer companies that we've liked for, quite frankly, a really long time. One of those companies is Lululemon. Lululemon, as we're showing you on the left here, is effectively a great growth company. It's a great consumer growth company. It's a share taker. This is market share in apparel. The good news about apparel or sportswear apparel is it grows at roughly 8%. So you're looking at share statistics within a market that's already growing at 8% anyway. Why does it grow at 8%? Because none of us wear suits anymore. And from that point of view, this is Lululemon taking share from some of the bigger players in the marketplace. If Lululemon continues on to execute in the way that they have, which is higher end products, technically more specific products that then roll into menswear, that then roll into further international exposure, and ultimately roll into casual wear, then it's pretty easy actually to get the company, even the revenues of this company to double over the next 5 years and the earnings to go up further. But what excites us the most is the opportunity that we got to buy it. So this is Lululemon's earnings growing over time. As you can see, they're effectively executing on the path that I showed you. And there's, at this stage, no reason to believe that won't continue. But instead of having to pay 55 times earnings for Lululemon like we would have had to back in 2021, we can now buy it at roughly 30 times earnings. And 30 times earnings for a company that's going to double within 5 years, you know, mathematically is a pretty good opportunity for upside. Sure, the multiple might go down from 30 to 20, but if the earnings double, you're still going to make at least 66% of your times your money in 5 years. And we honestly think it will hold that multiple because the growth rate will not have stopped by the time we get 5 years out from now. Exactly the same opportunity presented itself in Chipotle Mexican Grill earlier this year, where Jeremy on our team has put this into the fund. Basically, this is just showing unit growth in quick service restaurants. Quick service restaurants is clearly a growing category. Everyone on this call would know that by their own spending habits. Chipotle is taking share. For those of you who don't know Chipotle, it's essentially what Guzman Gomez copied their product of. Chipotle has been around a lot longer, and GYG is effectively a copycat product. We expect this to continue to grow. And again, this is the earnings growth trajectory of Guzman over this period of time. And this is, sorry, not Guzman, sorry, Chipotle, and this is the PE multiple. And again, the PE multiple has given us that opportunity. So taking a step back, interest rates went up a lot, multiples went down a lot. Here's your opportunity to buy the company. Interest rates stay flat, company will go back to following its earnings. And so mathematically, the risk rewards on Chipotle just got significantly better at the start of this year than say it was 2 years ago. And so that's why we think it's a good opportunity and a good thing that we should be leaning into at this point in the cycle. And lastly, I just wanted to cover climate. Climate's obviously been more difficult in the last 12 months. Climate's effectively going through, I suppose, the pull forward that tech went through the year before, if that makes sense. So a lot of pull forward in demand for climate, as there was a lot of excitement around the IRA, and there was a lot of excitement about, you know, how quickly we would decarbonize the planet. The reality is it's going to happen slower than that. And if anything, we've just seen a valuation adjustment, no different to the valuation adjustment we saw in tech the year before. From our point of view, it doesn't mean the opportunity's gone away. If anything, people are just more focused on existing technologies to get this solved. And we do think the best opportunities in climate are actually just sitting in plain sight. They're existing technologies that people are going to come around to adopting. And no more so was this true for Constellation Energy, which is our best performing stock in the climate area this year, and actually, you know, our third best performing stock for the year. It's a nuclear energy operator, and nuclear is slowly coming back into vogue. This is at COP28 just last week, where you have all of these countries committing to tripling their nuclear capacity by 2050. Nuclear is the best baseload, cleanest way to solve the problem of the power requirements that we're clearly going to need to roll out some of the AI technology I talked about, and effectively to allow human, you know, world GDP to continue. This is Constellation, again, simple earnings growth story around nuclear. This is definitely something you're going to see us lean a bit more into as the year goes on, and I'll talk quickly about some of the existing technologies that we like here also. Okay, so that's a very brief summary of our outlook for 2024 across all our funds. How we have the funds positions, as I said, they've all been fully invested since June, and what we think some of the big areas that we think are going to grow into next year are going to be. At this point, I just want to step aside and start talk about the climate fund very briefly, and then let Chow talk about the SMID fund. And then I'll come back to summarize on our main products and then take some questions. So as I said at the start, I just talked about the two products on the left for about 20 minutes and how they're positioned. Chow's going to talk about the SMID fund in a second. Let me just quickly talk about climate. And just to remind you, climate is really a thematic strategy that's there to help invest in the enablers of decarbonisation. I just showed you some of the companies we have in the main funds, but in the climate fund, we clearly have more. It's 100% focused on the same area. And right now, this is how we have the fund positioned across our 4 key verticals. The biggest one is energy efficiency. As I said, we do think the biggest opportunities here are just lying in plain sight. They're just simple things like insulation, heating, ventilation, and cooling, power management at data centers, circular economy ideas. And the one thing that we have really noticed in the last year is things like electric cars. We've definitely done an overbuild here. A lot of the new technologies have been overinvested in and overbuilt, and we're definitely stepping away from some of these newer or hotter areas of climate, at least in the short term as they valuation adjusts. For us, the big themes in climate sit around this, really focus on energy efficiency. Companies like Kingspan or Arm in the data center or Schneider Electric in the data center. Focus around regulatory, companies that solve, for hazardous materials like Clean Harbors or water issues like Veralto, and really solve around electricity taking share. Clearly, electricity is going to take share. That's baseload nuclear power. That's Quanta and engineering service. That's Nextracker. And then lastly, within all of that, there's a reshoring theme that we think will play out throughout the year. This is how the climate fund was positioned at the end of the year. And like I said, I'm happy to take further questions on this in the Q&A, or please don't be afraid to reach out earlier. And then at this point, I just want to introduce Chow Ma. Chow's going to talk about the SMID fund really quickly. Chow's been with us since February. We've been working hard, or she's been working very hard on putting this portfolio, and it's off to a great start. And I couldn't be more excited about the stocks that are in this fund. It's something that I think looks really good. But I'll pass over to Chow and let her talk about that fund quickly before I finish up.
Yeah. Thanks, Nick. Hi, everyone. My name is Chow Ma, and I'm a portfolio manager here at Munro Partners. I think I met most of you over the past couple of months around the country. It is good to be with you again. So we started the Munro Global Growth SMID and Mid-Cap Fund, which is called SMID, at the end of October. The fund had a good start and is up more than 10% since the launch. Now, the reason we started this fund is really twofold. One is the timing is really good. With the world just fixated on the top stocks, which we also love, by the way, the smaller end of the market is getting really cheap. As a matter of fact, relative to the big cap companies, the small and mid cap companies are the cheapest in 20 years. So the second reason is we don't really need to go far to find these companies. They are companies we know well. We follow for years. They're right in the Munro AOIs, right under our noses. And these are basically the long-term winners we think is for the next generation. So unsurprisingly, the top 3 AOIs for the Munro SMID Fund is high performance compute, consumer, and climate. Can we go to the next slide, please? And I just want to give you some examples to really drive that point home. So, when we look at high performance compute, Nick talked about it extensively. It's really our shared passion, really, over the past, 20 years. We love semiconductors. You've all heard him talk about ASML. Right in Netherlands, there was another Dutch semiconductor companies with less than 10% of ASML's market cap, and it's called ASM International. Now, 2 of the plumbing jobs in semiconductor, you really cannot make any semiconductors without these 2 jobs, is etching and deposition. And ASM is a leader in the high precision deposition, what we call the atomic level deposition. Very naturally and logically, as the semiconductors get smaller, the precision requirement goes up exponentially, and that plays straight into ASMI's strength. Within the SMID fund, we own roughly about 5 semiconductor stocks. We obviously don't own ASML, we don't own TSMC. So these are all the smaller companies we think are leaders in the niche market that's really going to be the technology leader for the next generation of semiconductor manufacturing. Within consumer, we love Lululemon. You just heard about Lululemon. Well, we also love On Running as one of our top holdings for the SMID fund. And now On's market cap now is less than 10 billion. That's the less than 20% of Lulu. And we think that this is really emerging as the leader for running. And I will tell you a little bit about that later. And digital enterprise, same story. We love ServiceNow for the Munro Global Growth Fund. And then for the Smith Fund, we have TradeWeb, which is a one-stop shop to digitize all the fixed income, interest rate, Forex, all the tradings that the trader need. And this is digitization, this is software, this is going to use AI to its advantage. And this is very much exactly the same logic why we love our software companies. So the parity really goes on and on and on, but the logic is the same, is we look deep inside the existing Munro AOIs and we ask ourselves, who is going to be the winner for the next 10 years? And they become the components of the Smith Fund. Next slide, please. So On Running is a great example. It was founded in 2010 by a number of hardcore marathon runners in Switzerland who just want to make a shoe that is high-end, that is a great performance shoe, but is also great for everyday wear. Roger Federer left Nike and joined On not as a brand ambassador, but as a 3% owner in 2019. That really shows you how much Roger believes in this company. So On's mission is to become the #1 brand for runners. And I don't know if you noticed, running became huge during COVID, and we're not going back to sitting on the couch. So On Running just crossed $2 billion in sales, and this compared to 10 billion for Lululemon and more than 50 for Nike. It is going global, it is getting into apparel, and it's going direct to consumer. This is exactly the same playbook that we saw that worked for Lulu, that worked for Nike 20 years ago, and we think that there is no reason why it will not work for On Running. Next slide, please. So this is what the Smith Fund looks like now, to the earlier point of really good timing. So we managed to find 21 high conviction, our best ideas that's going to grow earning for more than 15% per year for the next 3 to 5 years. And the entire portfolio is on sale. It is trading less than 25 times earnings. None of this company has high leverage. None of them is loss-making. So their growth really does not depend on external funding. We're really excited about these companies, and I look forward to talking to you more about the Smith Fund going forward. Now back to you, Nick.
Thanks, Chal. Much appreciated. So obviously I powered through a lot of material there, and we're definitely around for the next 20 minutes for question, but effectively to summarize, these are the areas where we see strong structural growth in the months and years ahead. That strong structural growth should equal strong structural earnings growth for the companies that we've identified. And that earnings growth should ultimately lead to the double-digit share price growth and performance that we're looking for across our funds. The last 2 years, I completely accept, have been a difficult period for growth equity investing. 2022 was difficult, and the recovery this year, we've definitely been a little bit more conservative than we should have been at the start of the year. But as you move through the year, you can now see quite clearly that rates have peaked. You can quite clearly see that the macroeconomic issues are effectively priced and companies are just going back to following earnings. And so what we're trying to do here going forward, this year and going forward, is to lean into our process, identify the areas of structural growth and identify the winners. The small cap strategy is just the next part of that. It's quite simply doing exactly what we should be doing right now, is going further down the market cap curve and further looking into the weeds of finding these companies that have effectively been thrown out over the last 2 years. And it's important to stress that the Munro Global Growth Funds are all cap strategies. I'm going to openly admit there's a couple of stocks in the mid cap fund that we're more than happy to put in the big cap fund because we really like them as well. No different to what we've done with the climate strategies. And so this is how we're positioned going into 2024. But we also, as I hope you recognize, are trying to identify how these structural changes are actually going to play out over the next 3 to 5 years and how the fund can benefit over the next 3 to 5 years. So just finally, just putting it into details, this is the Munro Growth Fund at the end of November. As I said, it has been fully invested since before June, so over 90% long since before June. The only thing that you should notice here is currency-wise, the Munro Global Growth Fund is generally roughly 50-50 hedged, and it's even more hedged today. That's meant it hasn't picked up a lot of the upside of the Aussie dollar falling from roughly 80 cents to 60 cents over the last 2 years. That has caused a bit more relative drag than we would have liked. We do think we'll get that back. And if anything, we're starting to lean a bit more into the hedging side here. On the right, you can see the top 5 positions and you can see how the funds are split. For our long only strategy, just to be clear, it's very similar, same long exposure roughly today. So no put options and no shorts, and fully currency unhedged. And so from that point of view, you can have the smooth product that does still have, the downside protection in it. And we are still, as I said, buying put options for any issues that may still occur. But ultimately, we are long-term positive markets, and we're long-term positive around these particular structural areas. And so from our point of view, our job is to think much more about 3 to 5 years than worry about the next 1 to 2 quarters. And with that, I will probably pause and see whether there's any questions. And thank you. For those of you who have to step away right now, thank you very much for your time and listening. And for those who want to hang around for the questions, we have a full 20 minutes here, Steve, to go wherever you want to go.
Okay, excellent. Thanks, Nick, and thanks very much, Chow. Just a reminder to everyone, if you've got a question, please send that through now. We'll do our best to get through them all. A couple of questions coming through, Nick, just in terms of what if EPS collapse has not occurred yet, with signs of the US economy starting to roll over? Is it not out of the question that earnings are going to come under pressure in calendar year 24, and that earnings per share weakness is not actually priced by the market yet? Have you got any comments on that?
Yeah, look, it's a great question. And I suppose what I can tell you is from the key areas of interest where we see structural growth, it's very hard to see this reversing in the short term. And so I can give you a couple of examples around, say, Google or say Microsoft. Okay, so let's just say Microsoft. Okay, Microsoft it participates in both areas of this stack. So Microsoft participates here and participates here. And so they're going to be charging Copilot out at $30 a user starting this year. So that's sort of free growth. And their Azure growth, their cloud growth is already starting to accelerate again because of this AI use. Amazon's the same. Their Amazon Web Services business is already starting to grow again. And so from that point of view, that's two of the biggest companies that it's highly unlikely that their earnings are going to reverse back down again from here because this AI has effectively created this step up. If I look at Visa or Google, potentially that could happen. But it's again very hard to see them losing momentum here. Google's managed to cut costs and started to grow again. Visa's continued to grow through it. And if anything, I would argue that yes, that you might be talking about a growth scare in the next quarter or two. I'm not saying markets won't get ahead of themselves in the short term, but if anything, you should actually be thinking about this rally broadening out. And I sort of tried to mention that with climate and some of the consumer names, because as you get through the first half of this year, the first half of next year, I'm sure there'll still be some bad retail results out there and some bad building material results, but eventually they're going to bottom as well. And eventually the market's going to look forward to a much broader recovery. And so from that point of view, and the reason why it's going to do that, because interest rates have peaked and potentially might even start to get cut in the second half of next year. And so I would just say that the window for that to happen is closing. And the window for that to happen, to make it happen, you're going to need something more and more dramatic to make it happen, because it's not like corporates don't know that there's a slowdown out there. It's not like corporates don't know interest rates have gone from 0 to 5%. They've been managing their inventories accordingly. And if anything, you're probably going to get the reverse. You're going to get a broadening out. And that's sort of how we think about it. And look, I'll give you one more example. If you just look at semiconductors that I talked about, clearly AI semiconductors are driving that. But you'll now see PC demand bottoming out. You're seeing mobile phone demand bottoming out. You're seeing server demand bottoming out. So if anything, the semiconductor growth I'm talking about is not just AI products. It's actually going to broaden out from here. So the window for that to happen, in our opinion, is closing.
Okay. A couple of stock questions, Nick and Chow. So what is your view of China trying to steal IP from ASML about lithography and developing their own alternative technique? Is this a big issue for ASML?
Yeah, look, I'll talk quickly about ASML, and then maybe, Chow, you can talk about the lagging edge if you want to. So ASML in this case, so it's important to remember that ASML hasn't been allowed to sell EUV technology to China since 2015. So it's been nearly 8 years now, or over 8 years, and China hasn't managed to develop an EUV product, and I can't see any way that they're going to. What they have been doing is buying a whole bunch of lagging edge machines to try and solve the same problem, and that's something we've been benefiting from in Applied Materials. And Chow, I might let you talk about that.
Yeah. So, just to the ASML question, there's a great book out there called The Architect of ASML. And I really recommend anyone. It's a huge read. But the gist of the book really is, the success of ASML does not just come from, machines and high precision scientific discoveries. Like it takes a lot of know-how and basically decades and decades of working with your customers to really know how to apply that technology to really the making of the and to integrate with the rest of the semiconductor chain. So I think that's just incredibly difficult to replicate within single country, within sort of a single vertical in a short period of time. And on the lagging edge is a really fascinating a phenomenon. What we end up seeing is because China is blocked out from buying some of these really highly productive next generation tools, then they end up ordering a lot more of the lagging edge, less productive tools. So in a lot of ways, it actually benefited our portfolio holdings such as Applied Materials, and then it even benefited the sort of the less spec version, what we call the DUV product sales for ASML as well. And then, ultimately, we do think that just given how many things are being manufactured in China, I mean, there is a lot of case to be made that they do need to have a lot of these domestic technologies. But we think as of now, they seem to be trying to develop the expertise in the lagging edge and not quite really making much inroad into the leading edge.
Okay, thanks, Chow. Just a couple of questions just around valuations and NVIDIA and the Magnificent Seven in general. You got any comments you can make there?
Yeah. So look, I mean, I will accept that. So what a lot of people may answer the question, the PE multiple of the S&P at 19 is high, considering rates are 5%, and maybe it should be 16. And I have some sympathy with that. The median stock PE is 16. It is the multiples of these higher end stocks that are pushing up the S&P. And the reason why is because, as I tried to flag, is they're growing. And if anything, their growth is accelerating. From our point of view, if you look at the Magnificent Seven, or even if you look at NVIDIA today, you don't have to pay more than 30 times earnings for any of them. The only one that's more than 30 times earnings, is Amazon. But that's, it's massively under earning. Its EBITDA is actually in line with the market. So, and even NVIDIA today started the year with a PE of 60, and it's finished the year with a PE of 20. Yet the stock's up, 250% for the year. So trick question, when was NVIDIA cheaper? And the answer is it was cheaper when it was at 60 times earnings. It's just earnings have grown dramatically. So from our point of view, the multiples I get are higher. They're sort of in the 20s range, 22 for Google, 27 for Microsoft, 25 for NVIDIA, etc. But they're not out of bounds. They're definitely not in .com levels. And you're at the start of a generational change in how we use computing. You're at a start at the start of this huge AI cycle. And the last thing I'd just say here is in my investment career, I've only ever seen something like this happen once before, and that was the mobile cycle. And the mobile cycle went for 10 years. Okay, and the mobile cycle obviously created Apple, but off the mobile phone that created Facebook, that created Google, that created Google effectively mobile search. It created Netflix. It created all of these different companies effectively came out of this mobile cycle and created this huge opportunity. You're effectively at the start of the next one of these, which is generative AI. And I've tried very hard in this presentation to explain why we think this is so big. And yes, it doesn't work perfectly today, but nor did the first iPhone. And so if you have to pay a couple of multiples higher to get that, that's fine. You're sort of year one at this, you're not year 5. And you're nowhere near bubble territory. And so from our point of view, I completely accept that they're higher than you'd want to pay, but they're not out of bounds. And, you're 1 year into something that's hopefully going to last at least 3 to 5 years and potentially last a decade. So the line we used in February to be able to get ourselves over the line to buy these things is we're like, it's around here somewhere. Sure, I'd like it 2 multiples cheaper. Sure, I'd like rates to go here, but it's around here somewhere. You've got to be starting to think about this on 3 to 5 year views, not on quarter views, and that will help you get to where we've got to.
Okay. A question on quantum computing. Can you comment on where quantum computing is sitting in all of this? Example, it has the potential to overtake much of the existing computer and chip tech in the cloud. Have you got any comments on that?
Yes, the answer is yes, and yes, it does, but it's got one big problem, which is cost. So quantum computing, in theory, on paper, can do all these things better than what, say, an H100 can do, but it can't do it at the cost that these companies can do it at. Okay, so the important part of this equation of getting from here to here is why did semiconductor demand grow by so much? Is because the cost of the products went down by 50% every single year. And as the cost of the semiconductors go down every 2 years, the use cases go up. And so the actual market grows. And so quantum computing will be amazing, and it will solve a lot of the world's problems. But we don't think it's likely in the next decade that you can get the costs low enough to work at any sort of industrial scale. And so it's definitely something we're looking at and working on, but it's not something we're actively investing in today.
Okay. Any observations about one of the newer portfolio names in the portfolio, Veralto?
Yeah, okay. So Veralto, just to be clear, and I understand we covered a lot of content here. Veralto is in the climate fund today. So it's not in the core growth products. The core growth products, to be clear, all cap growth products have 3 climate names in them today, 1, 2, 3. And Veralto is sitting inside the climate fund, which has roughly 24, 25 climate ideas in it today, or just over 20 ideas. Veralto, for the question, is a spin out from Danaher. It's it's a packaging and water business. We've liked Danaher for a long time. Veralto is effectively a pure play in this space, and it's definitely one that we're getting to know at the moment. It's a recent spin out and one that we hope to get more comfortable with over time.
Okay, great. Nick, I know you have owned PayPal previously and sold it very well. Have you got any thoughts on PayPal today, where that's at?
Okay, so PayPal would sit within the digital payments area. And so the one thing we did work out, thankfully, through our stop loss process in very early 2022, is that the world was just inundated with fintechs. And there was a lot of fintechs that were trading very expensively that were all effectively competing for your checkout. You went to checkout at an e-commerce site and there was like 7 buttons you could have clicked. And one of them was Apple Pay, which was just looming up in the background. And so from our point of view, that was PayPal's core business. They had it all to themselves for a long period of time, and then it sort of effectively got competed away from them. Since then, they've moved further down into other businesses. They have Braintree and Venmo and other areas. They're all much lower margin businesses. So we're not anti-PayPal. We just recognize that this is a period of adjustment to the P&L that's going to take time. And it's also an adjustment to the management because, we've lost the CEO, et cetera, there's activists on board, et cetera. So this is just a bit hard. So the same reason why we stepped away in the first place was this is all just getting too hard. We're going to step away. Since then, the stock's fallen like 70%. So we're surprised it's fallen as much. We have run the ruler over it a couple of times, but we're still not comfortable that the earnings are going to grow again. In this space, we have, to be fair, this is a good opportunity to plug what we have taken the opportunity to invest in, which is Wise. And for those of you who don't know Wise or don't use Wise, Wise is a cross-border exchange platform, i.e. for cheap foreign currency exchange. Doesn't sound that interesting, I agree, but ultimately what these guys have done is they've built it into a platform. And so this is a platform where they just create a range of products that ultimately are trying to do the one thing, which is to disintermediate the banks around FX exchange. And so those of us who use Wise, we use it as a business. We have Wise credit cards. We can move around the world and spend in different countries as if we live in those countries. It has 7 million users today. It's growing at 30% per annum. It's the stock we pitched at Son this year. Kieran pitched it at Son. And we just actually had the CEO in our office a couple of weeks ago, and we're about to release a podcast with the CEO. This is just a 10 billion market cap company. This is exactly what we should be doing right now. This is exactly what I'm trying to say on this webinar. These are $7 billion companies that we've always liked. When it came to market at 60 times earnings. We've just picked it up at 25 times earnings. It's still growing at 30% per annum. It grew at 30% per annum the whole way through this. Even the CEO was complimenting us on that we bought it quite well. And so from our point of view, this is what we should be leaning into, because these are the asymmetric upside opportunities. These are your 3 to 5 baggers. Yes, there's potentially downside. Yes, things can go wrong, but that's, our process, the stop losses that we talked about with PayPal can take care of that. These are the things we're looking for today. This is what we've been working on all year. This is what we've positioned the fund for at the end of the year. We just needed interest rates to take the foot off the market's throat. It did that in September, and look what's happened. And the reason why that's happened is because these companies are growing, and they're growing significantly in the background. They just need people to stop looking at the macro, stop worrying about rates, and looking at the earnings growth. And we think some of this earnings growth is going to really come through in the next couple of years. And wise is the fintech we like today.
Okay, great. Now, Nick, I'm conscious of time, so we're coming up to 1 o'clock. There's a question here, which is actually directed more to me, so I might answer that question, then I'll go to you and ask for any sort of final comments. But the question is, what is the timing for the SMID fund to be on platforms, and when will research be available? So you should expect to see the SMID product added to the IDPS platforms early in the new year. We'll also engage with the research houses early in the new year to get the fund rated. And then from there, we'll be on the road, and we'll, if you're keen to come along and have a listen to Chow and hear more about this product, then we'd love to host you at some of those sessions around the country early in the new year. And then from there, it will also make its way onto the super platforms as well. So it should be a really busy first quarter for the SMID fund. Now, Nick, as I said, it's coming up to 1 o'clock. Have you got any sort of final comments you'd like to make before we wrap up the call?
Yeah, so look, the final comments I'd just make is, look, I understand last couple of years have been a difficult period for growth equities, particularly 2022. 23 has ended up being a recovery year. All of our funds have done more than double-digit returns for the year, which is what we target. Recognise the Munro Global Growth Fund has lagged a little bit, but that's really just around preserving that absolute return mandate. What we're thinking about today is, how do you position this fund for the next 3 to 5 years as rates peak and potentially slowly come down? And where can we find that earnings growth? And that earnings growth will ultimately drive share price growth. These are the areas we've positioned the fund. You'll see a very similar thing across Climate Fund, and you'll see a very similar thing across the small cap products. And ultimately, this is us just leaning into what we do best, and basically putting this macro adjustment period behind us. The last thing I'd just say, look, from our point of view, please don't be afraid to use our website and materials. All of these good stories, I just talked about the WISE podcast we've got coming out. All of that stuff around advanced packaging, I get was pretty complicated. But ultimately, the website's there to help you look at this. It's helped you to look at what we're doing, to see the structural growth opportunity, and ultimately see that structural growth opportunity will equal earnings opportunity and share price growth that you basically can't get in the Australian market, and that you have to look globally to find. And that's what we're here to do. Last thing I just want to say is, have a Merry Christmas, everybody. Thank you very much for all your support. And look, we always appreciate our interactions with you, and looking forward to seeing you in the new year.
Terrific. Well, thanks, Nick, and thank you, Chow, for joining the call. Also, we really appreciate it. Ladies and gentlemen, thank you for taking the time. As Nick said, we hope you found the webinar today of value. If you have any questions from the session today or require additional information, please contact your GSFM key account manager, or as Nick said, go to munropartners.com.au for regular updates, podcasts, insights, etc. Finally, on behalf of GSFM and Munro, thanks again for your terrific support in 23. It's really appreciated. We hope you have a safe, enjoyable and relaxing festive season, and we're looking forward to working with you again in 2024. So with that, thanks very much, and enjoy the rest of your day. Thank you.